As we mentioned earlier, there are several different time frames suitable for trading. Mid to long-term trading is probably the easiest way to make a profit from trading currencies, while you need to allocate less time than when trading in shorter time frames. You will have fewer opportunities per year because long-term trends need more time to form. Long-term trades last from weeks to months. Since trends in this context take time to form and last longer, you don't need to watch the market several times a day. Taking a look at the market situation once a day for, say, 15 or 30 minutes in the evening, it's quite enough. The profit you can expect from trading successfully can vary between 10 and 30% per year, which represents quite a good reward. Mid-term trades last from days to weeks. They generate more opportunities, but their trends are not as stable as long-term ones, because forces behind those trends are not so strong and have a less prolonged impact. Some traders can even earn 10% in some months, but don't set your goals too high. Just use discipline, patience and proper risk management and let the market decide. Take only what's obviously offered to you, like easy to spot trend, and no more. Don't try to extort the market, but wait patiently and humbly and the market will reward you on a regular basis. Watching on the sidelines without actively trading is a sound and valid trading tactic, but it is important to be there. If you miss a big trend, it may seriously diminish your profit potential for that year. Short-term trades last from 1 to several days, even a week or two. There are plenty of opportunities, but trends formed during those time frames are temporary and not very stable. For example, as previously discussed, one particular trend, which starts after a big corporation buys Japanese yen against US dollars, may start out as a temporary trend because other traders jump in trying to profit from this move. Actually, this short-term trend may be started as an outcome that has a fully psychological rationale, rather than based on a real market situation. In order to maintain your trade, you will need to watch the market several times a day, which requires a lot of time and effort on a daily basis. Many traders somehow feel that they must trade every day in order to earn some money on a daily basis, as in a 9-to-5 job. But trading isn't a typical everyday job routine. As there are days when nothing happens, it is good to resist the temptation to trade and simply sit and watch instead. Don't underestimate that tactics. If you sit and watch patiently, market will offer to you easy to spot profit opportunities on a regular basis. There is no need to commit trades during unclear situations, just to actively participate. Sitting aside and watching is perfectly acceptable time spent in trading. Day trading is a well-known trading time frame where the position is opened and closed with the same 24-hour period. In my subjective opinion, this time frame is rather overvalued. It requires a lot of time and energy per day, while the results are often doubtful. Those mini and micro trends that are formed are based almost exclusively on human psychology and almost never on real and solid economic reasoning. That's what makes them closer to gambling. I'm aware that some of you will not appreciate this type of description, but it is actually true. It is semi-gambling, where you control your risk in advance, reading your technical analysis parameters, trying to outsmart others. It takes a lot of time, discipline, and effort to earn constant profits from day trading. Those who constantly thrive in day trading usually deserve their success. For those that are interested, I am preparing a specialized day trading course with some successful tactics. Scalping is the shortest time frame for trading. Average trade lasts anywhere from seconds to minutes. Although some traders are involved in scalping, and I certainly respect them, I wouldn't recommend less experienced traders to undertake scalping. Nowadays, the situation is even tougher because many institution traders have bots, which means that artificial intelligence algorithms tirelessly scalp for them. Very short time frames can force a trader to take a much greater risk than normal, as we will explain later on the course. There is one special hybrid time frame for trading, known as a swing. Swing traders benefit from swings in trade prices, which build a price pattern. For example, a so-called channel pattern is formed by currency price fluctuation between upper and lower ends of the channel formation, which can last from one day to a week. Swing trading can be quite a good time frame for trading, as we will discover later in more detail.